Well, US banks were sitting on $620 billion in unrealized losses at the end of 22. That's according to the Federal Deposit Insurance Corporation, or FDIC. However, research from several academics now finds that the US banking system accumulated $2.2 trillion in these unrealized losses over the past year. That's as much as 4 times the number presented by the FDIC. Now, these researchers also found that 10% of banks have had larger unrealized losses than SVB. So just how much risk is in the US banking system? And are more bank runs on the way? Well, joining us now to discuss is the co-author mentioned in the research, Columbia Business School professor and research associate at the National Bureau of Economic Research, Tomasz Piskorski. Thank you so much for joining me, Tomasz. So, when you look at the number of banks that were in a similar position to SVB, talk about why those didn't fail versus what we're seeing the fallout for SVB.
Yeah, thank you for having me on. So we did a first academic study on looking on how the recent rise in interest rates affect the market value of assets. I just want to mention 3 of my co-authors. It's together with Erika Jiang, Gregor Matfos, and Amit Seru. So I speak on behalf of the team. So what we find out, you have to first understand that US banks are very thinly capitalized. Typical US bank has about 10% of equity. So 90% of its funding comes from various debt instruments, predominantly deposits. And based on our analysis, the assets of the banks are about $2.2 trillion less. And it's mainly also the big difference between the number you quoted comes from taking into account also the assets they held to maturity. Think about the loans like real estate loans or corporate loans. So why SVB failed? So if you just look on current capitalization of US banking system, about half of banks actually have the market value of the asset less than the face value of liabilities. So you would conclude from this test that about half of banks are in trouble. Of course, this is a kind of an extreme view because it really all depends on the behavior of depositors on the deposit side. If most of banks are predominantly financed with insured depositors, they don't care about the risk of default of the bank. And as long as they are okay getting a very low deposit rates, that doesn't really create much short-term trouble for banks. The problem is, and here as Silicon Valley Bank comes, about more than 37% of bank liabilities are uninsured deposits. There's about $9 trillion of them in the system. And these depositors really are not insured in principle, and they should care a lot about solvency of the banking institutions, and they can also be much more sensitive to interest rates. And Silicon Valley Bank was essentially a bank that's not as bad as some of the other banks in terms of its real losses, but its funding was predominantly uninsured deposits.
And according to your research, more than 78% of SVB's assets were funded by uninsured deposits. So that really does put it at least in the minority in terms of the proportion there. But of the banks that do face the same risks as SVB, which ones are considered systemically important?
So we looked on, we essentially did a stress test of the banking sector. How many banks can actually survive uninsured depositor run? So first, the first scenario we consider, imagine at each bank, 50% of uninsured depositors withdraw their money. In this case, we'll have about 190 banks being in a precarious position, meaning that the remaining value of assets is not enough to cover the face value of the insured deposit obligation. And these banks account for $300 billion. But of course, if such run become more pronounced and wider, so we did another stress test. What if 100% of uninsured depositors withdraw their money at each bank? Then we have a very different situation. We'll have almost more than 1,600 banks being essentially potentially insolvent, and they account for $5 trillion of assets. And in this group, you have some very large banks.
And so talk about some of the banks within there, although we know obviously everybody is not going to do a bank run at the same time.
So, I don't want to give specific names because the last thing I want to do on your show is start a bank run. But among the largest top 10 banks are really some large financial institutions. So there is a significant risk to the system. And of course, you could say this is somewhat of an extreme scenario, 100% of uninsured depositors withdrawing the money. But I think what really our paper tries to make a point is that because of a large increase in interest rates, and how thinly capitalized banks were to start with, about 10% of the funding comes only from equity. there is really a significant increase in risk of uninsured depositor runs in the US banking system. That's something regulators should really think about.
So, Tomasz, I mean, when the unrealized losses did start to mount, inflation was peaking, you saw the Fed hiking interest rates. How did some of these banks really address the risk then, or did they really not?
Now, by my understanding, they didn't really hedge much of this risk, and they were kind of catch off guard when interest rates start rising. In some sense, this is the core of the banking business. They engage in maturity transformation. They invest in long-term assets, often at fixed yields, and they finance it with short-term deposits. I think what is kind of new in terms of the point we were making, and this risk has been building up for many years, is that a very significant part of bank funding does not really come from the so-called safe, sticky insured deposits. You have $9 trillion of funding coming from uninsured deposits, and it's big enough, $9 trillion, to potentially create a significant risk factor to the system if these uninsured depositors become nervous about bank solvency, or if just they seek higher yield by, say, moving their money to US treasuries. And it's obviously puts a potential concern for the Fed in terms of the inflation fighting objective.
And we know that the Fed has sort of highlighted some of this. They noted some weakness in some of these smaller banks and related that to real estate. But then you also have Treasury Secretary Yellen saying, look, they're going to really prioritize stabilizing the banks. But then you have to wonder then, what does this mean in terms of the domino effect on the banking industry when you do start, moving the goalposts on these FDIC limits here versus, say, other countries in the world?
So I think, what administration tried to do quickly, the regulators, is to sort of stabilize the system and prevent this uninsured depositor runs. I think in a short run, it calmed the markets a little bit, but of course, there is a longer question. Uncertainty still remains. And more broadly, after this episode, I think we really need to rethink much more the financial architecture of US banking system, including how it should be regulated going forward. Let me just mention, we have another paper in which we look on what is the capitalization of non-bank institutions. In the residential mortgage market, companies like Quicken Loans are the major lender. And guess what? When these institutions don't have access to deposit funding, they actually retain more than half of capital, more than twice as much capital as US banks. So in other words, institutions without access to deposit funding are much better capitalized and can, in principle, much better withstand a significant decline in the value of the assets.
That's definitely an interesting takeaway there. I do appreciate you joining me for your insights. Tomasz Piskorski there, Columbia Business School professor and research associate at the National Bureau of Economic Research. Thank you for joining me this morning.